Imagine a world where the most valuable corporations on Earth are no longer competing for code, algorithms, or software engineers. They are fighting for atomic reactors. In the remote hills of Pennsylvania, Microsoft is resurrecting a ghost nuclear plant at 3 Mile Island in a $16 billion deal, not to power public homes, but to feed a single, insatiable digital brain. The AI revolution has hit a physical wall. We are running out of electricity. Generating a single AI query consumes 10 times more power than a traditional Google search. Public grids are collapsing under the load, and big tech faces a brutal choice: buy nuclear power plants or watch the entire AI boom collapse. Welcome to Investing Made Simple.
For 30 years, tech investing followed a software fairy tale. Write code once, distribute it for free, and enjoy 90% profit margins. But large language models broke that law of economics. AI isn't traditional software. It is a physical computational furnace. Every query triggers billions of matrix multiplications across dense server clusters. By 2035, global data center power demand will explode from 460 terawatt hours to over 1,300 terawatt hours, consuming more electricity than the entire nation of Japan. So why not just build solar panels and wind turbines? Because of a fundamental rule of thermodynamics called capacity factor. AI clusters run 24 hours a day, 365 days a year. Solar operates at just 25% capacity because clouds roll in and the sun sets. Wind averages 35%. If grid power flickers for a millisecond, billions of dollars of active AI training data get wiped.
That leaves exactly one clean solution: nuclear power. Nuclear plants run at a 95% capacity factor, pumping out dense, continuous electricity uninterrupted for 2 years straight. Realizing this, tech majors kicked off the largest corporate energy land grab in human history. Microsoft locked down 3 Mile Island with a 20-year agreement. Amazon committed over $20 billion, buying a data center campus attached directly to Talon Energy's Susquehanna nuclear plant. Google signed a deal with Kairos Power to build a fleet of small modular reactors. And Meta eclipsed them all, locking in 6.6 gigawatts of nuclear contracts across Vistra, TerraPower, and Oklo. In total, big tech has committed over 10 gigawatts of nuclear capacity in a single year. Power is no longer an operational expense. It is a competitive weapon.
So how do we profit from this megatrend? You don't just blindly buy tech stocks. You map the entire nuclear AI ecosystem into 4 distinct investment tiers, each with a different risk-to-reward ratio. Tier 1, nuclear operators. Companies like Constellation Energy, Vistra Corp, and Talon Energy. By signing 20-year contracts with cash-rich tech giants, these once boring utilities have turned into high-margin growth compounders. Constellation shares have surged over 400% as Wall Street re-rated its earning power. Tier 2, uranium miners and fuel enrichment. You can build all the reactors you want, but they are useless without uranium fuel. Major producers like Cameco and physical funds like the Sprott Physical Uranium Trust sit in a market facing a decade-long supply deficit. Demand is becoming completely inelastic. Tier 3, small modular reactor pure plays. Companies like Oklo and NuScale offer microreactors built right next to data hubs. They carry massive upside, but represent high-risk pre-revenue bets. Finally, Tier 4, the hyperscalers. Microsoft, Amazon, Google, and Meta have unmatched balance sheets, but investors must monitor their $250 billion capex drag.
But on Investing Made Simple, we never ignore the downside risks. And right now, big tech's nuclear dream is slamming into 3 massive structural bottlenecks: regulation, grid politics, and fuel supply. First is grid equity. When Amazon tried to connect its Susquehanna data center directly behind the meter to Talon Energy's nuclear plant, the Federal Energy Regulatory Commission, or FERC, swung the hammer and rejected the proposal. Why? Because regional grid operators argued that allowing tech giants to siphon off nuclear power directly leaves everyday consumers paying higher transmission tariffs for the remaining grid.
Second is the regulatory obstacle course at the Nuclear Regulatory Commission. Restarting closed reactors like 3 Mile Island requires years of environmental impact reports, safety exemptions, and NRC license modifications. And for next-gen small modular reactors like Oklo or Kairos, clearing first-of-a-kind commercial licensing takes years of intense scrutiny before a single kilowatt flows. Third is the nuclear fuel bottleneck. Advanced SMRs require high-assay low-enriched uranium, or HALEU. Today, global HALEU enrichment capacity is severely bottlenecked. Furthermore, nuclear carries a substantial cost premium. At roughly $110 per megawatt hour, nuclear power costs nearly 3 times more than solar or wind. If big tech's AI software monetization stalls while their nuclear energy capex bills mount, short-term corporate profit margins will take a serious hit.
So, how do you construct a balanced portfolio around this nuclear AI renaissance? At Investing Made Simple, we favor a core and satellite allocation strategy. Allocate 50% of your nuclear exposure to Tier 1 operators like Constellation or Vistra, securing high-visibility, contracted dividend cash flows backed by 20-year big tech contracts. Put 30% into Tier 2 uranium miners like Cameco to capture the structural commodity deficit, and reserve 20% for high-upside Tier 3 SMR innovators like Oklo or Tier 4 hyperscalers who successfully solve their power bottlenecks. Watch key catalysts between now and 2028, NRC regulatory approvals, FERC policy revisions, and the restart of 3 Mile Island Unit 1. The AI boom isn't just a software revolution, it's an energy infrastructure war, and the companies controlling baseload power hold the keys to the future. If this breakdown helped simplify your investing strategy, hit that subscribe button, ring the bell, and leave your favorite nuclear stock in the comments below. Thanks for watching Investing Made Simple, and I'll see you in the next one.